Hey everyone, George here, your favorite crypto tax attorney. In this video, I'm going to break down everything about DeFi taxes. Before I get into everything, and there's a lot, make sure to like, comment, and subscribe down below. Do DeFi exchanges report to the IRS? No, they don't. But make sure you report your activity. They can see crypto leaving and coming into your exchange accounts, and fiat currency coming in and leaving your bank account. So just be sure to cover your bases. The IRS doesn't have specific guidelines about DeFi and DeFi taxes and how you're supposed to report this stuff. But if you have a specific question, you can come to us here at the Gordon Law Group and we can try best to answer it. Just like Binance and Coinbase and other centralized exchanges, there's only two main types of income that you're going to have on DeFi: ordinary income and capital gains. If you want to find out what those are, check out my other two videos that I did on Coinbase and Binance. Decentralized finance platforms like Aave allow you to put up collateral and get loans from other people without using an intermediary like a bank. The one thing is, when you put up collateral, that's a non-taxable transfer. And when you receive a loan, that's also non-taxable. But when you repay your loan, that's taxable. And if you get liquidated, that's also taxable. So what are the taxes for the people lending crypto? You pay taxes on the excess you receive back when you lend and get paid back. The excess is considered interest. Lenders should consider the tax implications on the crypto that is sold that was given as collateral for the loan. So what are the tax implications when you get liquidated? Well, the liquidated amount will be sold for the amount received as a loan, considering it basically a taxable trade, the collateral for the loan. If I borrow 100,000 USDT from Aave and put up 100 ETH, my ETH gets collateralized and liquidated, then it will be a sale of 100 ETH for 100,000 USDT. Governance tokens allow users to vote and control the associated blockchain. These tokens, just like any others, will be considered ordinary income at the time received and capital gains when they're sold. Is wrapping coins a taxable event? Well, experts differ. Some say that wrapping doesn't change the underlying asset, and some say it's a taxable event because it's a different asset totally. Let's talk about liquidity pools. Liquidity pools are when you put in a single or multiple assets and receive rewards based on the pairing. Any rewards you receive from these liquidity pools would be considered income. Conservatively, when you're entering into a liquidity pool, that will always be taxable. Let's talk about protocol or placeholder tokens. An example of this is AWETH, Aave WETH, which is what happens when you put ETH into the Aave platform and get this marker token in return. Conservatively, these would be considered taxable. If you wanted to take a more aggressive approach, you could consider it non-taxable. When you send your liquidity pool NFT tokens to stake, that's considered yield farming. When you do this, all rewards received from the yield farming will be considered ordinary income. If you don't report to the IRS at all, then you have a failure to file penalty. That could be anywhere from 5 to 25% for every month that it's not filed. The second penalty is a failure to pay penalty, which could be 0.5 to 25% for each month your payment is late. The third penalty, which is most relevant here, is the accuracy penalty, which could be anywhere up to 20% of the unpaid tax plus interest. Worst case scenario is you face a tax fraud charge, which happens because you didn't disclose all your wallets to the IRS. This could end up with you going to jail. We've taken a high-level view of DeFi taxes in this video. We've covered mostly everything, but please just make sure to report all of your crypto activity so it's easier for you down the road and everyone's happy. Make sure to like, comment, and subscribe on this video, and see you in the next one.